within the European market, you have a patchwork of different prospects going forward. You have some markets which are fairly close to fair value at the moment. Certainly compared with bonds and equities, property looks good, a good price generally. And certainly I would put the UK into that category. Although further yields should continue to move out throughout certainly Q2 of this year. In Germany and France, you'd expect further capital value falls during the first half of this year. In contrast, in Scandinavia, those markets look reasonably robust. There is rental growth coming through. The economies are doing relatively good rates of growth, as is Central and Eastern Europe. So it is very, very patchy. Most economists will no doubt tell you in 6 months' time that we are already in a recession today. And certainly from talking to investors across the US and our offices across the US, psychologically the economy is in a recession. It's very difficult to actually get any debt or raise any debt at a reasonable cost in that particular market. So liquidity has a significant problem. The net result of that, I fear, is that the Fed will continue to reduce interest rates. And that then brings in sort of good news and bad news. The good news is that rates are falling and therefore property becomes self-financing once again. The bad news is that it'll inflate a new bubble. And that's the real danger, because in 2 years' time there's a danger that we'll all end up with our fingers burnt if we're not very careful.